Hey guys, this is Pranav with TendieTrader. Welcome to the video. Today's video, we're going to be talking about bankroll management for options trading, aka how to not go broke as soon as you open an account. Before we get into that though, want to just ask you to hit subscribe if you enjoy this content. Gives us some great feedback on what type of videos to make in the future and what you guys are finding valuable. So let's get into it. What is bankroll management? Well, bankroll management is recognizing that the amount of money you have in your bankroll should always be dictating the stakes for which you play. And this is an important concept, right? Because if you got $100 in your account, you should be trading radically different than if you had $100,000 in your account. From position sizing to diversification, all of that comes into play the more money you have in your account. So it's kind of like staying in your financial lane when you're doing this. And ultimately, the reason you do this is because the higher stakes you play or the higher position sizes that you make, ultimately, it's going to lead you to going broke a lot faster if you make the wrong choices, right? And it's easy to make the wrong choices in the market. The news, sentiment, everything can flip on a dime. So just make sure that you're staying in your lane. So even if you go on a down streak, you're ultimately going to be able to ride that out until you get some wins back and build your bankroll back up. On the other hand, if you want to make that Lambo money and go for 10 baggers or shoot for the moon, go ahead, YOLO. Put your entire account on one position and 10x your money. Not gonna hate you for doing that. There's a lot of people that I know online that are pretty good at it and they do make money, but it does increase your variance. And if you can't handle those type of swings or watching your account, evaporate 50% overnight, then it's not going to be something that you'd want to try out, right? Because the emotional roller coaster that you have to ride when you're YOLOing is going to be pretty difficult in the long run to maintain, right? So we want to make sure we're being smart. We're playing position sizes and we're diversifying to make sure that we're ultimately not going to be able to, or that we are going to be able to ride those swings out. And the concept is essentially variance. So variance is the concept that ultimately there are going to be streaks where you're not going to win, right? So even if the odds are in your favor, and this is a concept that stems from poker, if the odds are in your favor and you make the best possible move within your control, but you run bad and you end up losing, well, you did the best possible thing you could in the moment, but ultimately you weren't able to successfully execute on that trade. So over the long run, you want to be making sure that you're coming out ahead, but those individual downswings, you want to be able to ride that out. So that's what variance is, right? So when you have a down variance, when you're going through down variance, you want to make sure that your bankroll management allows you to ride that out without having to go to zero, assuming that you're making the best possible trades and you're following your original investment thesis to a high level. And ultimately that the thesis is valid and that you're going to profit in the long run. But in the short run, we want to make sure you're not going to zero and then having to refund your account or ultimately stop trading altogether, right? And this graph is nice up and to the right. But if you're not practicing bankroll management, it's easy to go straight to zero. One wrong move or one trade that's a little bit too big for your account could theoretically take your account to zero overnight. And this is the type of chart we want to avoid when we're looking at our account balance, right? This is what's going to really hurt us in the long run. So there's two basic strategies when it comes to bankroll management, and we won't get into the nuances. There's a ton of other ways to implement proper bankroll management. You can hedge bets. You can do a ton of different things with straddles, strangles, things like that. But for a lot of us newer guys, I want to stick to just the two basic strategies. That's diversification and position sizing. If you can understand these two, you can minimize the chance of your account or blowing up your account. So what is diversification? Well, diversification is diversifying your account across multiple investments, companies, or sectors that minimizes the risk of one bad investment wiping out your entire account. So what does this mean? Well, it means if you're betting on, let's say, Delta's upcoming earnings, well, let's say they're completely terrible, more than likely it might drag the entire sector down. So you don't, if you have the option of making 5 different trades, you don't want to bet on every single airline, United, Delta, Southwest, because technically if the entire sector tanks, every single one of your bets or your trades is going to tank along with it, right? So making sure that you're at least playing a few different unrelated sectors or companies or whatever it may be, just making sure that they're not all going to move in the same direction based on one single factor. And the beauty of this is that's going to at least let you retain some of your account, even if one trade goes to zero. The second strategy is going to be position sizing. So the concept of position sizing is deciding what percentage of your total account you want to use for any particular position. So let's say you have $3,000. That's typically the minimum I recommend for anybody that's trying to get into options trading. If you have $3,000, we're going to split this up by the percentage of your portfolio or your account that you're making per trade. So 5, 10, 20%. What does that translate into? So 5% of 3,000 is $150 a trade, and that allows you to open 20 positions. Doesn't mean you have to open all 20 positions at once, but it gives you the opportunity of being right, or being wrong up to 20 times before your account goes to zero. Same thing, let's go with that same logic down at 10%. You have a position size of 300, and that allows you to be wrong up to 10 times. And 20%, $600 per trade, and only gives you about 5 times to be wrong. So ultimately, the concept here is rather than counting your wins, you want to be able to count how many losses you can sustain before your account is at zero, right? So playing at a 5% per trade is a lot less riskier than playing at 20% per trade. Obviously, the returns are greater if you make the right move on a 20% trade. But ultimately, if you're wrong, you only have 4 more trades before you're ultimately having to refund your account. So those two strategies, I would say, really take to heart if you are new to options trading. Just make sure that you're at least playing within your financial lane to make sure that as you're testing the waters and getting used to and learning about how options react to price movements, how sentiment and different Greeks can also affect the value of your contracts over time. Tons of different things go into this, but as long as you're maintaining a diverse portfolio and diverse set of trades, if you have multiple trades open at the same time, and you're also making sure that they're the appropriate size trades for your account value, then you're going to be able to ride out any down variance and make sure that over the long run, you're moving your account up and to the right. Well, that's it, guys. I appreciate your time today. Hope you guys enjoyed that video. Again, if you did, please hit subscribe. We love when you guys are getting value out of these videos, and we'd love to make more content that you guys find value with. So have a great day. Appreciate y'all, and I'll catch y'all on the flip side.